All right, let's get into the advisory now. Alternatives, of course, the investments that go beyond traditional assets. Travis Schindler from Hewison Private Wealth joining me to discuss the pros and cons. Travis, good to see you. Let's start off with the pros then, shall we? What are you seeing here?
Good afternoon, Juliet. Thank you for having me. So, look, the pros of alternative investments, which I guess that definition these days can mean many things to many investors, can also go hand in hand with private market investments. I guess the pros are lower levels of volatility. There's many research articles out there showing that the long-term returns, there's a premium on the return compared to public market equities. So lower volatility, similar if not better returns, and broad diversification away from traditional portfolios, particularly with Australian investors, which can be, very heavy towards the large miners and the large banks.
So, how is it becoming more easy for individual investors to really gain access to alternative investments?
The market has really developed and continues to develop compared to 2, 3 years ago, and even, especially 10 years ago. So access to these markets has been democratized. Many, fund managers are structuring products that are aimed at the private wealth market, even individual investors directly. So bypassing the private wealth space altogether. But effectively, removing things like, 10-year minimum investments, for example, providing, semi-regular liquidity, reducing the minimum investment sizes, and overall giving access to strategies and return characteristics that were historically limited to family offices or institutional investors.
So let's talk about the cons, because one of the things about investing in the market is if you want to access your money, and I guess similar with what people are seeing in some other assets too, like crypto, for example, you can get your money back within a couple of days. What are some of the cons in terms of being in alternative assets?
Look, I mentioned liquidity before. As I'm sure many of you guests have said before, everything's liquid until it's not. So, bringing a traditionally illiquid product to market through a liquid fund does have its potential risks. That's one con. I mentioned lower minimum investments. However, compared to public equities, there can still be, $250,000 minimum investment sizes for these types of strategies. Also, the dispersion of manager quality. So the difference between the top and bottom quartile manager and, private credit or private equity, for example, can be very extreme. And your experience in private markets or alternatives can be very good or very bad if you pick the wrong manager.
Well, that really gets us to the point of how you pick a good manager, and I guess what your advice would be to people trying to seek different ways to invest.
I think absolutely the first priority is to be cautious, seek advice. If you are confident doing it on your own, do your research. Make sure you've lifted the bonnet of the offer documents and read the terms and conditions of the fund. Looked at the manager's track record. Helicoptered up and actually looked at the market that you're investing in, whether that be venture capital or private equity, commercial property. Making sure that you understand the sector, the cyclical nature of that very specific part of the market, so that you know where you are, where you're investing, where your money's going, and really what you can expect along the way.
There's also, of course, really just checking all the boxes, if you like, about compliance. What would you say, Travis, to people that are unsure, particularly given that financial advice over the past few years has had a bit of a bad rap somewhat?
Oh, absolutely, and there's a lot of media attention on the wholesale investor tests, classification of sophisticated investors. So a lot of these alternative or private market investment opportunities are restricted to wholesale investors. However, in saying that, there's a lot of strategies and good quality strategies coming to market on the public market. So taking an alternative or unlisted product, putting into a vehicle that can be accessed via the stock market. So no matter how you're accessing any of these investments, it's important to do your research, understand how your money goes in, where it goes, and how you get your money out.
And Travis, I mean, if you look at the equity market, it's been a pretty awful start to 2025 so far. What are you seeing in terms of demand in alternative assets and I guess just client demand in general?
Well, yeah, absolutely. Equity markets have been for some time priced to perfection, which does present risk, as we've experienced at the start of 2025. We have some markets come off, but private markets are a bit more conservative in their book valuation. So a lot of these companies or strategies that are being invested in by private investors, they're coming in at a lower entry point, which we think can offer a higher margin of safety compared to going into public equities at the top of the market. And that's not to say that we time the market or pick one asset class over another. As we've seen before, markets can stay expensive for a very long time. So trying to predict market outcomes can be a dangerous game. But we think alternatives and private markets are there to complement listed equities, not there to replace it.